Welcome back to our accounting classroom. And today we are going to continue our look at partnerships. And last time we left off, we would have been talking about the items that should be included in a partnership agreement. And we acknowledged that the agreement could be either a written or a verbal agreement. However, it is best that we have a verbal agreement. However, it is best that we have a written agreement. That way, we would have less problems when there are any disputes because it is generally written down what all partners would have agreed upon. Now, when we are looking at a partnership, we have different types of partnership businesses. You can have a limited partnership and you can have general partnerships. Now, a partnership type business can have what we call a limited partner. And when you have a limited partner, this is known as a limited partnership act, and this must be registered with the registrar of companies as such. Now, when you have a limited partner in a partnership type business, all persons cannot be limited. A partnership must have a general partner because limited partners are not liable for the debt of the partnership business in any difficulty beyond the investment that they would have made. So beyond what they would have invested into the business, they're not liable. The creditors cannot come after their private assets, right? So that is why they're called limited partners. Remember, when you have a sole trader has unlimited liability. So general partners are the same way. They have unlimited liability in that when they cannot pay their creditors, the creditors can come after their personal assets. So we're saying with a limited partner, they're not liable for any debts. They cannot take out any part of their contribution during the partnership lifetime. So a limited partner cannot take out any part of the contribution that they would have made during the lifetime of the partnership. Additionally, a limited partnership, as I said before, must also make up of general partners because everybody cannot be a limited partner. Someone has to be liable for the debts of the business, and that's where the general partners comes in to play, because the general partner will be those persons who are liable to the debt of the business with their private assets. Also, a limited partner cannot take part in the management of the business. They cannot take part in the day-to-day running of the business. They are a limited partner, so they're not allowed to do that. And maybe some persons may want to refer to that person as like a silent partner because they make an investment into the business, but they don't get involved in the business otherwise than what they would have invested, and they're just looking for a return on their investment. So some people might want to refer to that person maybe as a silent partner, but the term that is used is a limited partner. Now, the conditions of partnership to which each partner must obey, as I said before, they can be either be written or they can be verbal. Now, if an agreement cannot be established from past knowledge of operations, then we are going to look at the following conditions that must be applied. And these conditions may be based also on the Partnership Act, right? So if they can't, based on what would have happened in the past, cannot come up with an agreement, then they must follow these conditions. The profits or losses must be shared among the partners equally. The rate of interest provided by partners The rate of interest on loans provided by partners is 5% per annum. And these things are based on the Partnership Act of 1890. So the Act of 1890 states that in the absence of an agreement, profits or losses must be shared among the partners equally. The rate of interest on loans provided by the partner must be 5% per annum. The Act also states that there's no interest granted on capital. There is no interest charged on drawings. There will be no salaries granted to the partners. All right. So the agreement can have all or few of the conditions which must be followed in the preparation of financial statements. So when there's a partnership agreement, the partnership agreement does not always have to have interest on drawings. It doesn't always have to have interest granted to the partners on their capital. So you can have an agreement where it states that there's interest on drawings, but then it doesn't grant any interest on capital. It doesn't grant salaries. So it can, as we stated, the agreement can have all of what we would have stipulated before, or it can have few of the conditions when we are preparing the financial statements. Now, the capital contributions, now the partners can contribute the partners can introduce all investments at the start of the business, or they can contribute during its lifetime. So, for example, the person can put in an initial amount invested as their capital, and then over the lifetime of the business, they can keep increasing the amount of their investment by putting in more and more capital into the business. Right, so they can put it all one time, or they can do it over the lifetime of the business. The profit or losses, these are shared in a ratio agreed upon in the conditions, or they're shared equally. Now, some partners, as I said before, are guaranteed an amount of profit regardless of the total profits earned. Right, so the partners must be granted that profit at the partner must be granted that profit at the other partner's expense or partner's expense. So some partners, as we said, are guaranteed a profit regardless of what the total profit earned. So if you guarantee that the minimum profit that a partner can receive is, say, $5,000 per annum, it means that it doesn't matter what happens, that particular partner cannot get less than $5,000 per annum. So if you're looking to calculate the share of profits based on the ratio, and you see that their profit is going to fall below that $5,000, it means that you have to give them the minimum, which is the $5,000. So that's the minimum they can get. They can get more, but they cannot get less. And this guaranteed profit is at the expense of the other partner or other partners, because it means that the other partners then have to suffer in getting less, because this person needs to get what you guaranteed them in the first place. The interest charged on drawings is usually charged as a deterrent to the partners from withdrawing too much cash from the business. Because if you have partners keep withdrawing cash all the time from the business, then you may end up in a situation where you don't have enough cash to maybe pay salaries, pay off your creditors, buy assets, and do the regular things and dealing with the day-to-day operations of the business if the partners are withdrawing cash. So therefore, the firm will charge them an interest to deter them, to stop them from withdrawing too much cash from the business. The interest provided or granted on capital is at a rate provided per annum to increase the profit awarded to the partners. So when we go back and we look at interest charged on drawings, interest charged on drawings is usually added to the net profit that would have been calculated from the income statement, and that interest increases the amount of profit then that would be appropriated or distributed or shared with among the partners. The interest now granted or provided on capital is deducted from that profit before you actually start to share in the profit sharing ratio. So it is at a rate and it's increased the profits awarded to the partners before the share is divided. The partner's salary is also deducted from the profit, and that amount is awarded to the partners also before their share is divided according to the ratio as well. The financial statements of the partnership are usually prepared similar in nature to the sole trader or to the limited company. There's not much difference in preparing the financial statements. And the income statement should be prepared to determine the profit or loss given in the period. And then you have what we call a statement of appropriation or an appropriation account, which is attached to the income statement, or it can be shown separately, which outline the distribution of the profits or the losses which were generated for that period. So you can do the income statement, come up with your net profit, and then you can always then start your appropriation, statement of appropriation with the net profit that you worked out from your income statement and show how that profit or loss is distributed to the partners. The statement of financial position at the particular date is usually prepared similar to a sole trader or a company. The difference is in the capital section of that statement, where you have adjustments where you look at the capital account and the current account, etc. But otherwise, the statement is similar in nature. So the statement of financial position at the date must be prepared after the adjustments have been made to the capital accounts of the partners. The capital accounts can be prepared either using fixed or fluctuating capital accounts. So this is basically a look at what the capital account, how we prepare it. We prepare it in a columnar format where you just draw one account and you put the names of the partners in columns so that you will not be repeating details. You will be just changing numbers. So this is what it would generally look like. So it's prepared and represented in a columnar format, and you have, as I said, like fixed capital account. Now, the fixed capital account is generally used, these are generally used separating contribution and non-current activities from current activities. So the fixed capital account would generally just show what the person would have invested during the year and what their investment would look like. So it keeps showing that amount. So when you have fixed capital account, then you also have the current account is prepared, which record the activities occurring during the period. So then you see like the interest on capital, the salaries, the share of profits, the interest on the loan, and those things are credited to the current account. The drawings and the interest on drawing is debited to the current account. So then you see what profit what the person would have left in the business, or what they would have withdrawn in excess. So that's what the current account will show, right? So as I said, this is represented in columnar format, the current account as well, just like the capital account, right? So the fixed capital account would enable you to quickly detect whether a partner is withdrawing too much from the business, and you can take action as soon as possible. Whereas the fluctuating capital account is a combination of the fixed capital and the current account. Those things come together. There's no separation. And in terms of the profits and the investments, what is going on in the period. And with the fluctuating capital account, it's usually difficult to see or detect when a partner is overdrawing, and you cannot really, unless you closely monitor it. Sometimes by the time you realize it, it is too late. So this has been a look at an introduction to partnership accounts. and we will come back with an example question, and we would like you to like this video and subscribe to this channel, and thank you for watching. We hope that it is beneficial.